finance. Efi, you consider embedded finance as one of the main trends, not hype at an early stage of experiments. How do you understand this term, and what is the reason for the rise of it, and will it really solve problems?
Well, embedded finance is all about integrating financial services into businesses, at their website, mobile app, or their processes. And what is really exciting about embedded finance is that it is linking the real economy with financial services. So we're talking about embedding financial services in non-financial businesses like restaurant businesses, the mobility sector, e-commerce. So this is really an innovation. And it's both serving and benefiting the end customer, but also the provider, the merchant. So it's a win-win situation. And I think that it's also very much in alignment with this trend of creating ecosystems through these partnerships between the financial providers and these non-financial, customers. If you want to think of travel industry and again cars and restaurants, creating payment experiences. If we're talking about embedded payments, that is, I would say, the largest sector. And from the customer's point of view, it's a seamless experience. And from the merchant's point of view, it's got a lot of benefits. First of all, it increases the possibility of the long-term value or the lifetime of the customer. So more engagement expected from the customer, increased revenues, cross-selling opportunities, and needless to say that the merchant has access to data and data insights that they did not have before through these transactions or attempts and behaviors. All this data is very valuable. When I think of embedded finance, I think of it as what has led to the growth of banking as a service. That is a big, I would call it a sub-vertical of embedded finance. It's powering embedded finance. So here we have banks and fintechs providing banking services to non-financials. And this is estimated to be a huge business. Cornerstone Advisors estimates annual revenues of 25 billion, roughly, in the next couple of years, just from banking as a service providers. We're even seeing traditional banks, especially in the US, jumping into this business and understanding that this is not, oh, we are dumb pipes. It is actually a valuable service. They realized that, especially during the lockdowns during COVID, where e-commerce and digital behavior, contactless payments, and changing the digital engagement of large parts of the population became, suddenly a norm. Anderson Horowitz estimates that embedded finance, broadly speaking, we're talking embedded credit, lending, payroll, and so on, is a huge business in the order of 7 trillion. So overall, I would say that embedded finance is a huge opportunity. It's in alignment with the platformification of the economy, really. Financial services are behind the real economy. And APIs are obviously the key, the connector that is enabling all this. And APIs is nothing new, as you know, Dennis, but the way we can use APIs to create innovative experiences, that is what is new. And again, we have the opportunity to create experiences that combine payments and marketing, combine payments and sales funnels, and we'll have the opportunity to innovate further and create innovative processes at the supply chain or the logistic layer. Again, embedded finance is a huge opportunity.
So, what examples of successful implementation of various types of embedded finance from different regions can you share?
I mean, I think buy now, pay later is a great example of really combining marketing and payments. And if you think of Klarna, it's really empowering the merchants that are on its marketplace with marketing tools, loyalty programs, and so on. That's an innovation. If we look to Zip, which is an Australian buy now, pay later company, and they've embedded insurance in their products, and especially for large items. There's an example of embedded insurance in e-commerce. I would say the classic example of the big ride-hailing companies like Uber and Lyft. Lyft is a great example that has empowered its drivers within its app to manage their financial lives. So they have a debit card, they can access immediately their earnings, they have savings accounts and so on, all within that app. This is just embedded finance for cash flow management of financial lives is ever more important. And again, we'll realize it more now in this tough macroeconomic environment. If we look in India, WhatsApp, the messaging app of Meta, they have integrated payments. And now their 60 million users there will be able to do payments, peer-to-peer payments. That's a huge use case of embedded finance. All over the world, we see that creating contextual experiences for customers is super important. If we look in Asia, where the super app model has been born, and we Westerners admire it, of course. We can look at Grab, for example, out of Singapore, and growing in Southeast Asia. They have embedded investments through Grab Invest on top of payments and credit and so on. So you see these examples are, there's a full range from payments to investments to credit to insurance.
Let's talk about open banking. 86% of banks are going to use open APIs. What are your thoughts on open banking regulation and Europe's leadership? And what is happening around the world in open banking today?
As you said, Dennis, Europe has been a leader with their PSD2 regulation, and they've been continuously in the forefront. They are planning by 2024 to implement the open finance, going beyond open banking, a regulation that will, go into mortgages and further. And, these regulations have two major benefits. One, for the incumbents, it's a way for them to innovate, experiment in a compliant way. And from the innovator's perspective, it allows them to really build platforms in a way that is scalable because of the availability of these APIs. Now, the competition is fierce, and who knows who will be able to grab most market share from this open finance, if you want, trend. What is interesting to recognize is that there's the open banking, open finance regulation, and countries across the world have realized that this is beneficial for their economies. So each of them are at different stages in terms of implementing open banking regulation. For example, Brazil has been ahead. They've implemented open banking to their benefit. There are other countries like the US and the United Arab Emirates that are still in consultation and review mode. India last year made strides in terms of their open banking regulation, and they're seeing the benefits. Those benefits are in combination with the infrastructure that they have built, at the heart being their national digital identity infrastructure, and UPI, the Unified Payments Infrastructure, also being a public-private-led initiative that has allowed them to bring forward their people, 1.5 billion people, 1.4 billion people, to the digital economy, and they're building a very important fintech ecosystem. What I would say is that there's a distinction between the regulation and what is market-driven. And even though in the US, for example, the open banking regulation is behind, the market-driven open banking regulation has grown. You see companies like Plaid, for example, which really is a company that is designing these connectors, APIs, connectors for everything. It's really powering open finance and enabling, 6,000 fintechs, thousands of institutions to get into open banking, and it's done without the regulatory framework. So we're seeing, these forces from the market, but also regulation catching up. I would say that the only part of the world where there isn't an open banking regulatory framework is China. However, they have forced their two big tech fin providers, Tencent and Alibaba, to open up the walls of their relatively closed super apps. So again, we are seeing the market force of openness, invisible as it is, really shaping the market forces and the business models that are enabled always to serve better the underserved.
In your speeches and articles, you spoke about openness as a Greek goddess. Why do you consider this feature special? How can open API technology change the world of traditional banking?
You know, for me, openness is really an invisible force that's transforming the economic activities. And it goes beyond just open banking and the regulation and so on. And I do insist in this, thinking of openness as a goddess, because this conveys the message that she is powerful and you should be afraid of her powers, and you should actually try to befriend her, maybe make offerings to her. She is in charge, and that should be clear. Whether she's operating in fintech land or blockchain for finance land or big tech land or traditional financial services sector, she is there. Do not, think that she is gone. Look, in the US, we have already seen her way of operating with this market-driven openness that I alluded to before with Plaid. Think of Plaid as a factory of connectors. If you like to think of Legoland, then Plaid is producing the connectors for you to build, and it's open to you to build whatever structure you want, always to serve needs of underserved, to overcome the frictions of the existing system. I mean, at the payment level, we have a lot of these frictions. Think of, cross-border issues. And again, API technology is not new, but it can solve problems in completely new ways. I never forget the memo that Jeff Bezos put out back in 2002, that's 20 years ago. He instructed Amazon employees at the time that they should communicate strictly and only through these digital interfaces, APIs. And if they don't do that, they will be fired. This is a famous memo of Bezos that every financial services provider should have hanging on their wall, be it, even as the wallpaper on their digital gadgets, and never forget, because it is about the API-fication internally and in such a manner that you can communicate with the external world and build ecosystems and platforms. At the end of the day, Dennis, we do have the technical abilities right now to build profitable businesses and sustainable businesses through these modular ways. What we are lacking is probably the human intention and the culture to make this happen. We all know that it's one thing to deal with the technical debt, but in combination, we have to deal with the human debt to make this happen. And the message for me is clear. You need to invest dollars and time. You need to think along the lines of open ecosystems, and APIfication is the way to go. And it is what openness, the Greek goddess, is telling everybody and guiding everybody. So befriend her and be guided by her.
What innovative business models in the financial services sector have proved successful worldwide over a decade of intensive innovation and financing?
I mean, there's a couple that we admire, especially in the West. The first one that comes to mind is the Asian, Chinese, and Southeast Asia innovation, the super app business model. The second one is from India. It's at the infrastructure level, the intelligent design that combines the digital identity at the heart and the unified payment initiative, and it's around financial inclusion. The third one is from Africa and Southeast Asia, the successful way of delivering financial services from telecommunication companies, mobile money, think M-Pesa, and so on. And the last one that's proving now to be successful in the West, in the developed world, is this open banking, open finance, and embedded finance business model. So if we look into the super app model, by the way, a term that was not even coined where the model was born, it was coined in the West. I believe that the founder of BlackBerry coined the super app term, and it's been successful no matter how you look at it in terms of monthly active users, in terms of volumes of transactions, just bringing up a huge economy like China, huge population of 1.5 billion into the digital world and empowering them like you would empower a whole sort of community of ants. No wonder why the logo of ant is what it is. It's about empowering the small guy and empowering at scale. And then in India, also how you bring another huge population, rural and not digitally enabled, into the contemporary digital economy. And there it is done through these two main infrastructure, the combination of those. Africa, as I said, M-Pesa started really a revolution 15 years ago with mobile money, and today in Africa we have a hugely competitive mobile money sector with many players, and that is a proof of success. And the proof of success of open finance here in the West is really the growth of API ecosystems and fintech services that are built on this, leveraging this technology and offering financial services in contextually innovative ways.
So we recently interviewed Paolo Cerroni, and his latest book is devoted to the theory of platforms. What is the difference between digital platforms and ecosystems in the financial services sector from your point of view? And do you think that the platform economy is our future?
For me, the best way to understand these differences is through an example. One of my favorites is Square, nowadays named Block, that was founded by Jack Dorsey and Jim McClavey back in 2008 or 9, I think. So we're talking about a fintech that is now publicly traded, over 10 years old. And if you look at what they have today, they have a dual ecosystem. One is for retail, Cash App in the US, and then the other one is for sellers, for merchants. And when they started really by providing this Square dongle that you could attach to your phone, and sellers could pay and receive payments. So that in itself was just a regular, what we call linear business. No platform, no ecosystem. Fast forward to today, and Square offers a whole a suite of services to its sellers. Sellers can, within the Square ecosystem, they can process their taxes, their reports, their marketing, any needs, any business needs they have, they are served within the Square ecosystem. And that is done either through building in-house technology or partnering. But even when they're partnering, the seller accesses the partner within the Square ecosystem. So the integration is seamless from the customer's point of view. Square has even integrated the seller part with the retail part, with Cash App. And they continue to build what I would call the complexity of this ecosystem. So Square Block is a great example of a dual ecosystem with greater complexity. Now, juxtapose that to Venmo, which is a peer-to-peer app like Cash App, and it's part of the PayPal family, but it is not integrated seamlessly with PayPal. So if somebody in the US logs in and uses Venmo, they cannot seamlessly access all the services of PayPal. So therefore, that is not an ecosystem. I hope that makes it pretty clear. And as an example of a platform, I would say that the best example is the peer-to-peer lending businesses. Those are platforms that what they do, their business, is to bring together borrowers and lenders to transact. They facilitate the transaction. They are not platform-based ecosystems because they don't offer services to the borrower around, let's say, if you're borrowing because you want to buy a car, they're not facilitating all the services around, this, like owning a car or running a car and so on. So that's the difference. I like to think of platform-based ecosystems as orchestrators of value creation and looking how to create like an operating system for a specific business. We're talking about businesses or a specific goal if we're talking about the financial lives of people. And what has become clear is that public markets and private markets have been rewarding companies that are platforms or platform-based ecosystems with higher valuations. Why? Because they have proved that they can be twice as profitable with half the employees, that they can grow faster. And actually, this is a success that is not only in financial services, but in other sectors too. So I would say that the platform-based ecosystem model, as Paolo Cironi, describes and preaches in his book, is very successful and will continue to be successful in financial services. It has been proven in other sectors, and it's time to see it implemented in financial services, even though we have always been hiding behind the excuse, oh, we are different because we are regulated because of this and that. We're no different. We're in the digital economy. We are here to orchestrate partnerships and create value to serve the end customer, be it retail or business.
Let's go deeper into innovations. Efi, you've seen a lot of innovations in customer service and fintech. Could you share with us the latest successful examples that are worth looking up to?
I mean, in consumer banking, we are now at a stage post-COVID where contactless payments, peer-to-peer, instant payments, 24/7, low-cost exchange rate transactions, remittances, trading, they are pretty much, I would say, standard and expected by most customers. I would say that one of the biggest innovations, successful innovations that continue to unlock value at the customer experience level are mobile wallets. And there's different kinds across the world. If you think mobile wallets are not just, a digital version of my physical wallet in my handbag, what a mobile wallet offers is really beyond what was possible before. From the merchant's perspective, mobile wallets enables them to create value to customers through offers. The offers, the loyalty programs, the contextual experience is just amazing, the breadth. They have location-specific capabilities. So if I'm traveling, to guide me with offers and considerations, they can be specific to my preferences and very timely and customized in terms of offering choices to pay. A mobile wallet goes beyond payments. It can hold tickets, for traveling, tickets for events, be it in the entertainment sector, be it in business. It can hold invoices and receipts for individuals, but also for merchants. It goes beyond that to the point that it can hold identity. Think of Apple and the US that recognizes a driver's license as a legal identity. It's in the wallet. So the wallet has become really a very powerful, I would say, digital innovation that is very essential for the innovative customer experiences that are being created and continue to be created as we speak. The other big innovation is around using artificial intelligence. And here we have multiple innovations. It can be around investing, think ESG investing, think predictive analytics, and empowering and democratizing and enabling access to services or investments that were exclusive to high net worth or only corporate and institutional investors before. So we have really opened up access to tools and opportunities that did not exist before. I would say those two for me are really the big ones in terms of customer experience.
Where, in your opinion, will innovations in financial services develop most actively?
In my opinion, the disruptive activity is going to happen at the infrastructure level. It's kind of not so visible, but there's a lot of building happening as we speak. And think of it, everything, most of what has been built today in fintech is on the old infrastructure level. It's on the old rails. Think of, payments. Payments are running on the old rails. SWIFT, which is a network with 11,000 institutions in over 200 countries. This is powerful network for processing payments, but it is an archaic messaging system. And it is actually the reason that the two large card networks, Visa and MasterCard, are a duopoly, because they solve problems in the frictions in the payment system that exist. And at the cross-border level, even more. And if you think of it, again, fintech, for the most part, is built on the old rails. So it's time to innovate at that level. And there is competition out there. There is competition to change. Look at what is happening with CBDCs. How many countries are interested in researching the possibilities and changing the way money moves around the world. Why? Because of blockchain and distributed ledger technology, which is disruptive at the infrastructure level. It's no wonder we have, for example, NASDAQ or DTCC also very much researching and launching side projects that are distributed ledger powered. Why? Because they see that the disruption is big at the infrastructure layer, be it payments or settlement of equities, for example, for DTCC. The other very important disruption and where a lot of activity is happening is in fintech, we are in a rebundling phase. And in this rebundling, there's a lot of innovation happening. I think there at the integrating, payment layer, we will see more innovation, and we will innovate and integrate logistics and supply chains and really integrate with the real economy. Why is this important? Because at the end of the day, finance is serving real economic activity. It's not in itself an end proposition. This, however, requires investments and capabilities in terms of data flows, connecting the real economy with the digital economy and what enables it. So these are the powerful two, I think, very active areas, if you want, and there's a lot of building that we will see it fruition in the next 2 or 3 years.
Payments are complicated, especially cross-border ones, and you already mentioned CBDC as a solution. So does it have the potential for a more seamless cross-border flow of money?
I mean, look, CBDCs from a technological standpoint, they could definitely reduce the cost of cross-border flows and improve efficiencies around compliance and anti-money laundering and so on. However, so much depends on other factors in terms of the success of CBDC, because think of it, the success of a CBDC within a country or cross-border is all about the last mile of its adoption. It's also about the regulatory framework, the policies for cross-border movement of money, be it CBDCs or fiat, and the geopolitics. I mean, when I look at existing CBDCs, the ones that are already live, and I take the example of the Bahamas sand dollar, it's already 2 years old. It's been live for 2 years. But last year, they had to partner with MasterCard to help them in this last mile. So forget about cross-border. Adoption domestically has not happened. So adoption takes time. The last mile takes time. And if I think, let's say, 5 years down the road, let's assume that we have 20 live CBDC projects. Right now we have 5, and most of them are in small countries. We need to build the infrastructure so to enable the interoperability between these CBDCs. Who's going to build that? I don't know the answer, but will it be Visa and MasterCard again that are already building and launching infrastructure for the private stable coins like USDC? As a service, they already offer it. So these are the questions that are, challenges in terms of the success for cross-border payments with CBDCs. And let's not forget that, China, which is ahead of everybody in terms of their CBDC, the digital yuan, ECMY, and they're already testing and piloting cross-border with Hong Kong and maybe, Southeast Asia. But geopolitics, I can't see that there's going to be easy interoperability with the developed world. So again, there's a lot of factors that will determine the success or the value that can be unlocked with CBDCs for cross-border payments.
Let's look at fintech from different angles. Efi, in which areas have fintech failed or had difficulty to scale over the past years?
I would say that the first failure that comes to mind is this mantra from the early days of fintech that they would replace consumer banking. They would get rid of banks, whether it was self-drive money or the digital neobanks, that they would be replaced. There was a war out there for a couple of years, and the truth is that traditional consumer banks are here. They are competing. They have been gifted the gift of competition, and they are striving to transform digitally. And I think the big failure from the fintech's perspective is they underestimated the difficulty and the high cost of acquiring customers. The cost of acquiring customers and their technique to acquire customers, their ways of acquiring customers, honestly was no different than what the traditional banking providers deployed. Different offerings, mails, mass mails, advertising, and so on. The other failure was that the wave of robo-advisors and digital investing, that was another big mantra and a war that was started in the US with Betterment and Wealthfront, especially Wealthfront, the very hardcore self-driving money founder of Wealthfront. The truth of the matter is that none of these businesses have been sustainable, profitable, standalone businesses. They have been leapfrogged by the incumbents. Look at Charles Schwab, offering $30 advice per month and a $300 annually subscription package, and having, let's say, I think the incumbents in terms of robos have 80% of the assets today. So what has failed is the standalone version. They have succeeded in transforming the sector, but that is their failure. And I don't want to mention how many of the robo-advisors had to close down in the meantime, with one of the most recent ones being Motif. The other fintech failure, is in the peer-to-peer lending space. That if you look today, there are few of the original peer-to-peer lender providers, from Lending Club to Prosper and so on. And if we look at the UK, one of the first and very important UK peer-to-peer lending providers, Zopa, that is, I think, 15 years old or 16 years old, they have been obliged to close down their peer-to-peer activities, which had about 60,000 customers, and they've basically pivoted to banking. So that is a proof of the failure of the big vision of peer-to-peer lending. China also, their peer-to-peer lending failures there is another tainted part of the fintech history, but there it is the lack of regulation that created that fintech disaster.
In which areas of fintech are they involved? And can we say that there will be a complete monopolization in the future?
In the West, the big techs, the GAFAs, Google, Apple, Facebook, and Amazon, I would say that they're primarily and traditionally been involved in payments. And, payments, again, they're not boring and they're not simple. For me, the GAFAs are focused on really delivering contextual payment experiences. They're not in the business, to earn the interchange fees or anything. Really, it's about being able to create contextual payment experiences within their ecosystems. And a great example is looking at what Amazon has done to date, and they have been very early in payments many years. So fast forward to today, and Amazon not only offers a rich digital wallet as we understand it today for customers, but also a payment network for its merchants. And its merchants on its marketplace is a very important part of its business, and therefore enabling them with digital tools is very important. Again, they're into payments to provide contextual experiences to their retail customers and empower their merchants. Amazon is also innovating with technologies and with their patent or their patented technology of just Go technologies that they're using in the Amazon Go stores, where you can walk in, take the merchandise and walk out, and you need to do nothing in terms of payments, frictionless payments with biometric technology and so on. And no wonder Amazon has been invited by the European Central Bank to be part of their digital euro project. Why? Because they want them to develop e-commerce payment prototypes for the digital euro. So you see how they're involved in payment experiences. If we look at Apple, the Apple Wallet is also an important part of Fintech, and especially with their ability in the US to hold the digital identity, the driver's license, they have a huge advantage in terms of the customer experience in payment. But let's not forget that Apple also announced recently the so-called breakout plan, which is about building in-house payment rails. And the reason they want to do that, in my opinion, is they want to cut ties with the card networks and be able to create personalized customer experiences that are bundles of hardware and software that they offer, because software is a high margin business for them and they want to grow it both for retail but also for merchants. On the other hand, if we look, big tech has been involved in credit offerings, again for their merchants' loans, but it's mainly through partnerships with banks. Amazon and Apple are examples, but I don't see that growing. I would also say that what Google has done with their recent failure to launch Googleplex, which was supposed to be the checking account and was really well received from the market. There were surveys and people expected a big success upon launch, and they finally decided to stop it. So that shows again that there is a difficulty in really monopolizing and being afraid, in the West at least, that big tech would really monopolize financial services because of this embedded finance possibility. We have not seen that, and it seems that it's much more difficult than it appears. Even Apple, with their buy now, pay later offering and the separate financial subsidiary that they launched for that, they are delaying that, so we see the difficulties. On the other hand, if we look at the East, the big tech there, the bats, Baidu, Alibaba, and Tencent, they definitely have been involved and have been monopolizing the financial services there because there was a huge need and because there wasn't any regulatory restriction. However, the regulator now is obliging them to break up entities and separate them. Baidu has actually done it a while ago, and they're continuing along that path. I do not foresee regulators being kind in the West either with the big tech. I mean, let's not forget the failure of Facebook, Meta, with their Libra project and their DM project. That has completely failed, has been shut down, and has actually gifted the whole economy this growth of interest that goes beyond interest, of research into central bank digital currencies. So we have to ironically thank big tech in the West for pushing jurisdictions and governments to finally say, we have to take it in our hands and not let it be something developed by the private sector and the big techs.